What is cryptocurrency? Cryptocurrency is a digital or virtual form of currency that uses cryptography for security, making it difficult to counterfeit. Unlike traditional currencies issued by governments, known as fiat currencies, cryptocurrencies operate on decentralized systems. Cryptocurrencies are based on blockchain technology, a distributed ledger enforced by a network of computers. Bitcoin, created in 2009 by an entity using the pseudonym Satoshi Nakamoto, was the first cryptocurrency and remains the most valuable and recognized today. Cryptocurrencies share several key properties that distinguish them from traditional forms of money. Now that we understand what cryptocurrency is, let's explore how blockchain technology works. Blockchain technology serves as the foundation for cryptocurrencies, providing a secure and transparent way to record transactions. A blockchain is essentially a chain of blocks containing information. Each block is linked to the previous one through cryptographic hashes, creating an unbroken chain of data. Let's look at what's inside a block. Each block contains three key elements: transaction data, a timestamp, and a cryptographic hash that links to the previous block. The block header contains critical metadata, including the previous block's hash, a Merkle root summarizing all transactions, a timestamp, and a nonce value used in mining. The body contains the actual transaction data. A key innovation of blockchain is its distributed nature. Instead of being stored on a single server, the blockchain is maintained simultaneously across a network of computers called nodes. Each node in the network maintains an identical copy of the blockchain. This distribution eliminates single points of failure and makes the system highly resistant to attacks or outages. When a new transaction occurs, it must be verified by the network through a process called consensus. This ensures all nodes agree on the state of the blockchain. Each node independently validates the new block according to the network's rules. If a majority of nodes reach agreement, the block is considered valid and added to the blockchain. One of the most important features of blockchain is immutability. Once a block is added to the chain, it cannot be altered without invalidating all subsequent blocks. If someone attempts to tamper with a block, the hash values change, breaking the chain. This makes blockchain extremely secure and resistant to tampering or revision. To summarize, blockchain technology creates a secure, transparent, and immutable record of transactions through cryptographic hashing, distributed storage, and consensus mechanisms. This powerful combination makes blockchain the perfect foundation for cryptocurrencies and many other applications. The cryptocurrency market has evolved dramatically since Bitcoin's creation. Bitcoin, created in 2009, was the first cryptocurrency and remains the largest by market capitalization at over $820 billion. Ethereum, the second largest cryptocurrency, revolutionized the space by introducing smart contracts, which are self-executing contracts with agreement terms written directly in code. Beyond Bitcoin and Ethereum, the market has thousands of cryptocurrencies, each with unique features and use cases. Bitcoin dominates with approximately 40% of the market, followed by Ethereum at 20%. Other major cryptocurrencies include Binance Coin, Solana, XRP, Cardano, and Dogecoin. Each cryptocurrency offers different features and capabilities, addressing various needs in the digital economy. Smart contracts enable decentralized applications, while DeFi protocols offer financial services without intermediaries. NFTs represent unique digital assets verified by blockchain technology. Transaction speeds vary dramatically, from Bitcoin's 7 transactions per second to Solana's impressive 65,000 plus TPS. Different consensus mechanisms, like proof of work and proof of stake, determine how transactions are validated. Many cryptocurrencies specialize in particular sectors or solutions. Binance Coin powers the Binance Exchange ecosystem and BNB chain. Solana offers high-performance blockchain for decentralized applications. XRP facilitates cross-border payments. Cardano uses a scientific approach to blockchain development. And Dogecoin, which began as a meme, has gained significant adoption. As the cryptocurrency market continues to evolve, new innovations and specialized tokens emerge, all built on the foundation of blockchain technology. Cryptocurrency mining is the process by which new coins are created and transactions are verified on the blockchain. Miners play a critical role in maintaining the integrity of cryptocurrency networks by validating transactions and securing the blockchain. Let's start with Bitcoin's proof of work system, which is the original consensus method used in cryptocurrency mining. Miners first collect pending transactions from the network and organize them into a block. They then compete against each other to solve complex cryptographic puzzles, which require enormous computational power. The first miner to solve the puzzle gets to add their block to the blockchain, creating an immutable record. As a reward, they receive newly minted coins plus transaction fees from all included transactions. Bitcoin mining requires specialized hardware called ASICs, application-specific integrated circuits, designed exclusively for mining. A major drawback of proof of work is its enormous energy consumption. Bitcoin mining alone consumes more electricity than some entire countries. As an alternative, proof-of-stake systems like Ethereum 2.0 operate on a different principle that requires far less computational power and energy. Instead of computational competitions, validators lock up or stake their existing coins as collateral. The network then randomly selects validators to create new blocks, with higher stakes increasing selection chances. The selected validator verifies transactions and adds the new block to the blockchain. They earn rewards proportional to their staked amount, incentivizing honest participation. Staking is like depositing money in a bank. The more you stake, the more chances you have to validate blocks and earn rewards. The most significant advantage of proof of stake is its energy efficiency. Ethereum's transition to POS is expected to reduce its energy consumption by approximately 99.95%. Let's compare the key differences between proof of work and proof of stake systems. While proof of work relies on computational power and energy consumption, proof of stake depends on economic stake and requires minimal energy. This fundamental difference affects security models, centralization risks, and environmental impact. The future of cryptocurrency mining is trending toward more sustainable and energy-efficient models, with many new projects adopting proof of stake or hybrid approaches from the start. Cryptocurrency wallets don't actually store your coins as physical wallets do. Instead, they provide access to your assets on the blockchain through private keys. Private keys are secret codes that prove your ownership of cryptocurrency on the blockchain. Think of your wallet as a viewing glass that allows you to access and manage your assets, while the actual coins exist on the distributed ledger. Cryptocurrency wallets generally fall into two main categories: hot wallets and cold wallets. Hot wallets are connected to the internet, offering convenience for regular trading and transactions. Examples include exchange wallets, mobile apps, and desktop software. However, their constant internet connection makes them more vulnerable to hacking attempts. Cold wallets, by contrast, remain offline for the majority of the time. Hardware wallets like Ledger or Trezor and paper wallets where keys are physically printed provide enhanced security against online threats, but are less convenient for frequent use. Let's cover some essential security best practices for protecting your cryptocurrency. Always use two-factor authentication where available to add an extra layer of security. Regularly back up your wallet information and store it in multiple secure locations. Never share your private keys with anyone, under any circumstances. Consider investing in a hardware wallet for larger cryptocurrency holdings. Keep your wallet software updated to protect against known vulnerabilities. Use strong, unique passwords for each of your cryptocurrency accounts. Remember this crucial point. With cryptocurrency, you are essentially your own bank. This gives you financial freedom, but also means you alone are responsible for the security of your assets. With a solid understanding of wallet types and security practices, you're better equipped to protect your cryptocurrency investments. Cryptocurrencies can be purchased on various exchange platforms, with Coinbase, Binance, and Kraken being among the most popular options. When trading cryptocurrencies, you can exchange between different coins or convert them to traditional currencies like dollars or euros. Each transaction typically involves fees that vary by platform. For more experienced traders, exchanges offer advanced trading options. Limit orders let you set specific buy or sell prices. Margin trading allows trading with borrowed funds for increased leverage. Futures contracts enable agreements to buy or sell at future dates. To manage cryptocurrency's high volatility, many investors use a strategy called dollar cost averaging. This involves investing fixed amounts at regular intervals, regardless of market prices. This approach reduces the impact of volatility and eliminates the need to time the market perfectly. Cryptocurrency regulation varies dramatically across the globe, creating a complex landscape for users and businesses. While some countries have embraced cryptocurrencies, others have taken restrictive approaches. These regulatory differences create a fragmented global ecosystem for cryptocurrency users and businesses. El Salvador made history in September 2021 by becoming the first country to adopt Bitcoin as legal tender. This landmark legislation requires businesses to accept Bitcoin for payments and established a government-backed digital wallet. The country's primary goal was to increase financial inclusion for citizens without access to traditional banking services. In stark contrast, China has taken increasingly aggressive measures against cryptocurrencies. The Chinese government banned cryptocurrency mining in 2021 and prohibited financial institutions from facilitating crypto transactions. Instead, China is focusing on developing its own government-controlled digital currency, the digital yuan. The United States takes a multi-agency approach to cryptocurrency regulation, with several bodies claiming oversight depending on how the cryptocurrency is used. The Internal Revenue Service treats cryptocurrencies as property for tax purposes, meaning capital gains tax applies to crypto transactions. The Securities and Exchange Commission regulates crypto assets that qualify as securities, while the Commodity Futures Trading Commission oversees derivatives markets. Across different jurisdictions, regulators share several common concerns that drive their approach to cryptocurrency oversight. Investor protection is a primary focus, with regulators seeking to shield consumers from fraud, scams, and market manipulation in the highly volatile crypto markets. Financial stability concerns center around preventing systemic risks that could potentially impact traditional financial systems. Finally, preventing illegal activities such as money laundering, tax evasion, and terrorist financing remains a key driver of cryptocurrency regulation worldwide. As cryptocurrencies continue to evolve, regulatory frameworks are likely to develop in response, creating an ongoing tension between innovation and oversight. Cryptocurrency markets are characterized by extreme volatility, with prices often experiencing dramatic fluctuations. It's not uncommon to see double-digit percentage price changes within a single day, creating both opportunity and risk. Several key factors contribute to this extreme volatility. Market sentiment driven by fear and greed can cause rapid price movements. Regulatory announcements from governments worldwide can trigger significant market reactions as crypto operates in an evolving legal landscape. Technological developments, such as protocol upgrades or security vulnerabilities, can dramatically shift a cryptocurrency's perceived value. Market manipulation is also a concern, with large holders known as whales and coordinated pump-and-dump schemes influencing prices. Beyond price volatility, cryptocurrency investors face significant security risks. Exchange hacks have resulted in billions of dollars in stolen funds over the years. The industry is plagued by scams, including fake initial coin offerings, Ponzi schemes, and fraudulent exchanges designed to steal your funds. Perhaps most critically, if you lose your private keys, your cryptocurrency is permanently lost with no recovery method, unlike traditional banking where passwords can be reset. Unlike traditional financial systems, cryptocurrencies lack key protections. There is no FDIC insurance to cover losses from exchange failures or hacks. Legal recourse is limited due to the decentralized and often cross-border nature of cryptocurrency transactions. And with no central authority, there's no customer service department to call when something goes wrong or disputes arise. Cryptocurrencies have evolved beyond speculation to offer real-world practical applications. Let's explore how they're being used today, starting with cross-border payments. Traditional international transfers rely on multiple intermediaries, resulting in higher fees and slower processing times. Cryptocurrencies enable direct peer-to-peer transactions that significantly reduce fees to less than 1% and can settle in minutes instead of days. Smart contracts are self-executing agreements that enable decentralized finance, or DeFi services. These programmable contracts automatically execute transactions when certain conditions are met, enabling lending, trading, and staking without traditional financial intermediaries. Non-fungible tokens, or NFTs, represent ownership of unique digital items. Each NFT contains verifiable information about provenance and ownership that is stored on the blockchain. NFTs are used for digital art, virtual real estate, game items, event tickets, and many other applications requiring proof of ownership and authenticity. About 1.7 billion adults worldwide lack access to traditional banking services. Cryptocurrencies provide financial inclusion through mobile wallets, requiring only a smartphone and internet connection instead of traditional banking infrastructure. Beyond these major applications, cryptocurrencies and blockchain are being used in numerous other real-world scenarios. Remittances benefit from lower fees and faster processing times, helping migrant workers send more money back home to their families. Digital identity solutions give individuals control over their personal information while providing secure verification methods. Supply chain management uses blockchain to track products from origin to consumer, ensuring authenticity and ethical sourcing. As these real-world applications continue to develop and mature, they're pushing cryptocurrency adoption beyond speculative investment and into practical everyday use. The cryptocurrency ecosystem continues to evolve rapidly, with several key trends shaping its future. Central bank digital currencies are being developed by governments worldwide, while institutional adoption continues to grow. Decentralized finance, or DeFi, is creating new financial services without traditional intermediaries. Environmental concerns are driving a significant shift toward more energy-efficient consensus mechanisms. Technological improvements are focusing on three critical areas. First, scalability solutions are being developed to handle more transactions per second. Second, interoperability protocols are enabling different blockchains to communicate with each other. Third, enhanced privacy features are being implemented to protect user data while maintaining transparency. While the future remains uncertain, cryptocurrencies have already demonstrated their potential to transform aspects of the global financial system. As cryptocurrency technology matures, it will continue to challenge and reshape our understanding of money, value, and financial systems.